important, but let's move on and throw some light on the entire hospitality, travel and tourism sector in India. We have a note that came in from ICRA yesterday, and before we get in touch with the management at ICRA to help us understand a better, to help us get a better picture on the travel and tourism trends in India, let me give you a brief of what that note states. And they've revised Indian hospitality industry outlook to stable from positive. Now, this of course comes on the back of a slight dip in the tourism demand that we've seen in India, especially in light of the situation that we've seen in the north, northeast, northwest. Those are some areas that are seeing a dip in demand. So we'll also be chatting with the author of the note to understand if this demand is seeing any resurgence. But before that, while we're talking about the note, they're also saying that their average run rates, which is the ARR of hotels, that's expected to reach anywhere between 8,200 and 8,500 from the earlier 8,000 to 8,200 level in FY25. So at least that is some space where they're seeing some sort of hope or positivity returning back to the sector. They're saying that on the back of these April terror attacks that we've seen, that has caused a disruption in tourism as well, but also on the commercial end of things, that's known as MICE tourism, which is meetings, incentives, conventions and exhibitions. So even the commercial aspect of tourism demand has taken a little bit of a knock. They say that the impact was temporary and localized, and they believe that the sentiment has recovered as the conflict has eased. But when you take a look at the foreign demand that's coming for Indian tourism, foreign tourist arrival is expected to stay low in the short term but recover gradually going ahead, and domestic tourism remains strong and will lead the demand. And lastly, they're also saying that their coverage of 13 hotel firms that they have under their radar, they're saying that FY26 margins could range anywhere between 34 and 36%, and premium room supply is expected to grow at anywhere between 4.5% and 5% CAGR over FY23 to 26. So that's the outlook coming in on the note that we are getting from ICRA. But we also have Mr. Srikumar Krishnamurthy, the Senior Vice President and co-group head at ICRA, who's joining us. And so thanks so much for joining us this morning, and help us understand, first of all, want to understand your stance that you have on the current state of travel and tourism and hospitality in India. What has led to the downward revision of the hospitality sector outlook from positive to stable now, despite steady occupancy, and your optimism on the ARR growth?
Yeah, good morning, and thanks for having me. The domestic hospitality industry, as we all have been witnessing, has seen a very sharp recovery in the last 2-3 years. To give a context, we had earlier revised the business outlook for the sector from stable to positive a couple of years back in March 2023. When we anticipated that FY24 and FY25 could be a kind of breakout years for the sector, given the demand-supply mismatch in the industry. This is because post-COVID, we all observed that there was a resurgence in demand with the reopening of business and also the travel. However, the supply addition and the related announcements were gradual, and part of the old projects which were kind of deferred were kind of mostly renewed. One side we saw that the demand trajectory continuing to be on the upside. The supply addition also gradually picked up pace. But in this industry, as the gestation period for a supply addition is generally long, anywhere ranging between 3 to 5 years. On the other side, we noticed that the demand, specifically in the premium room segment, was growing in the double digits, while the supplies were kind of rising only in the mid-single digits. This was kind of positive for the industry, with improvement in both ARRs as well as occupancies. So during this phase, FY24 and 25, we noticed that the industry hit the all-time high level, peak levels of 70 to 72 odd percent,
right,
as again decadal highs of somewhere around 66 to 68 odd percentage. And the fact that it remained at 70 plus zone in FY25 as well reflects that the demand story is continuing to stay.
Sure.
Important, the ARRs, because of the supply demand mismatch, went up by around 10 odd percentage in FY25. And this supported a double-digit growth for the industry in terms of revenues in FY25. So effectively, we are talking on a very high elevated base. On this elevated base, we are expecting this pace of growth to kind of moderate. While the environment remains resilient,
sure,
segments like leisure, MICE, business travel, spiritual tourism all remain favorable. Although FTA still remains a laggard, but we still believe that the scope for sustained expansion in the pricing, while we do expect somewhere around a 4 to 5% increase in ARRs, the sustained expansion in pricing that was witnessed in the last couple of years is kind of unlikely. And accordingly, we see that the revenue growth to kind of moderate, or rather the pace of growth to kind of moderate to the normalized levels of somewhere around 6 to 8%, and hence the revision in outlook from a business standpoint.
Fair point. So largely you're saying that it's going to be a base effect which is going to be at play. Is that right?
You're right.
Right. Also, given the temporary impact of the April terror attacks, do you see any indicators that are signaling that sentiment hasn't quite fully recovered, at least in the north and western parts of the country?
Sure. The developments around the April and May has certainly had an impact with regard to the sentiments, specifically in the the northern belt. This had led to a good amount of cancellation of travel as well as MICE segment. But this was largely temporary, and to some extent, we would say that it was pretty much localized. In the last 2-3 weeks or so, we have been seeing a good recovery in the sentiments. But still, the fact that we are talking about a period, April, May, and June is not a very strong quarter for the industry, relatively a softer quarter. So the impact is unlikely to be very significant from a demand standpoint. But nevertheless, yes, it has been a localized kind of an impact that we are observing in the industry. The other pockets, ignoring these regions, we see that demand sentiments have remained quite stable.
All right, Mr. Krishnamurthy, there was a temporary hit back in the month of April because of the cross-border tensions, but help us understand what's the sentiment right now, and especially what is that you're penciling in for the second half for North and West India?
The business travel sentiments per se has actually kind of improved. The kind of resumption of business activities and the travels adjoining are pretty much back to its pre-March levels. What we also see is that the kind of the travel sentiments around this leisure demand that is likely to have its own season. So that will also kind of continue to be stable going forward. The important element of the important leg of the growth for this particular sector was the FTA, which is still at pre-COVID levels, which was expected to kind of revive and come back more specifically across the geography, not only the northern market. That will take some more time for that sentiments to kind of come back.
Okay, but sir, while you were talking about a comparison with the pre-COVID levels, you also expect operating margins of anywhere between 34 and 36% in FY26, at least in your sample set of the 13 hotel companies. Help us understand how this compares with pre-COVID historical averages. Is this any better from the travel and tourism backdrop that we were seeing pre-COVID era?
Sure. The inherent margins in the sector are quite strong. The gross margins are very strong in this particular sector. What has happened during the phase of COVID, we noticed that there has been good amount of measures taken towards controlling cost. People were very closely monitoring the staff to room ratios. There have been a very disciplined approach towards maintaining that ratio even after the demand kind of came down. So this has kind of supported the players to kind of look at cost rationalization as an important metric. And if I have to compare to the pre-COVID levels, still it would be far better than the pre-COVID level of margins because of this particular aspect of cost rationalization story and the pricing advantage. So we are talking about an ARRs which are kind of at a record level. The last upcycle, if you have to talk about way back before 2008. At that particular period, the ARRs were good, but it was not actually continuing or sustaining for the simple reason that the supplies were also parallelly coming in. So a good amount of discounts were there in the system. Now we see a scenario where still the supplies are expected to come back, after possibly a year or so. So there is a good amount of premium that the industry is able to maintain, and that is supporting the margin expansion, which along with the cost rationalization measures taken by the hoteliers are supporting.
Before we let you go, just one last outlook that you have on tourism in India, because with foreign tourist arrival expected to remain muted, as you've mentioned in the note, what's your medium-term view on international travel recovery for India? And do you believe that themes like spiritual or medical tourism could boost foreign tourist footfalls? Because that's exactly what we've seen in the Mahakumbh earlier this year, where a lot of foreign tourism influx is something that we had seen in India.
Sure. FTAs were expected to kind of come back. It does take a phase of 3 to 4 odd years after a bigger event like a COVID for people to kind of gain confidence and then kind of commit to the travel. This was a year that was expected, but I would say that it has not significantly affected the demand in the sector. To a large extent, there were other legs, newer legs like the spiritual tourism and also to some extent the revenge travel, those kind of aspects to a large extent supported the occupancy. That's where we are seeing the record high level of occupancies. While we notice good premium on the pricing front, largely supported by the absence of supplies, the pricing could have been still better had the FTAs kind of came back to the pre-COVID levels even the last couple of years. So there was a possible miss, I would say, if those FTAs had kind of come back. With the story kind of continuing, wherein the FTAs are likely to take some more time to kind of come back, this would still have an impact on the ARRs and also the margin effect. So, long story short, the FTAs do support the pricing factor, but the demand has not been affected because of the FTA story, as other segments like newer segments like spiritual tourism and also the revenge travel, these kind of sub-segments have kind of supported or filled in that gap.
All right, Mr. Krishnamurthy, with this, we'll let you go on that. Thank you so much for taking the time out and speaking with us.
Thank you.
But with this, viewers, it's now time to slip into a very short break.